Dina spoke in our market review that equity market posted a strong rally in Q4 2023 and so far into 2024 on the back of stronger trend of receding inflation. Markets' rate cut expectation at the start of 2024 have moved aggressively to price in March and multiple cuts throughout 2024, which in our view was too optimistic. Since then, the timetable of rate cuts has been pushed back, and we continue to think a scenario of a higher for longer is much more likely, with realized inflation remain above target and labor market remains surprisingly tight, prompting policymakers to take a slower and a steadier approach to avoid chances of reigniting inflation. Domestically, services inflation continues to remain sticky, with housing, particularly rent inflation, presents a major challenge. Whilst the most recent CPI was better than anticipated, we still see a cautious and holding stance from the RBA. Monetary policy aside, we're also seeing improved economic momentum coinciding with a resilient labor market, recovering retail volumes, and manufacturing PMIs bouncing off the contraction territory. These give support to economically sensitive sectors that have significantly lagged the growth sectors since recovery. In a scenario of soft landing, we'd expect to see a greater rally in cyclical equities, small caps, high-grade credit, and real rate sensitive assets, as the valuation of these sectors are much more modest and presents a higher earning upside than the growthy part of the market that is required to meaningfully surpass their highly anticipated earning expectations. With that said, weakness continues to linger in the US consumer health, with increased dependency on credit cards, pickup in delinquency rates, and depleted personal savings, all pointing to uncertainty around aggregate demand, which is arguably required to battle inflation. Whilst the persistent trend of disinflation gives a greater buffer for policy error, history does remind us that policy errors are difficult to foresee. If an economic slowdown was to eventuate, broad equity beta would underperform, especially those with the rosiest earning forecast and the highest valuation levels. And in this scenario, we'd expect government bonds to protect portfolios, as recessions are in nature deflationary. In the current paradigm of uncertain and volatile economic outlook, we think investors should take a diversified stance, particularly now with fixed income providing an attractive yield and is potentially protective to equity downside surprises. Through the midst of uncertainty, Innova continues to rely on our time-tested process of being valuation disciplined, seeking risks that are fairly compensated for, and reverting to our philosophy of protecting capital and generating a return for the longer term.